Hi everyone, welcome back. So, in the previous session, we discussed about the different types of companies. Okay, now before we move on, let me ask you a question. What happens when a business grows very large? And what if the business requires huge capital, many investors, and professional management? Now, we have already seen for such type of businesses, partnership may not be sufficient. Now, this is where company form of organization becomes extremely important. And in India, like we have already understood, companies are governed by the Companies Act 2013, which provides the legal framework for formation, regulation, and management of the companies. Now, in this session, we will focus on three important aspects. That is, one, we will speak about registration of companies in India. Second, we will speak about share capital and its stages, and also about the different types of share capital. Okay. Now, let us begin with registration of companies. Okay, so a company does not come into existence automatically. Now, you think and tell me, is registration of company compulsory in India? The answer is yes. So, registration of companies is compulsory in India, whereas registration of partnership was not compulsory, if you can recall what we had studied in our previous sessions. Okay, so a company comes into existence only when it is registered under the Companies Act. Now, this process of registration is called as incorporation of the company. Okay. Now, the companies are registered with registrar, registrar. Okay. So, registrar of companies, we call it as ROC, which operates under the Ministry of Corporate Affairs. Okay. Now, let me start with a quick question. Okay. Think about this. If a group of people simply decide to call themselves a company, does the company legally exist? Of course, no, because I told you the company has to register with the registrar of companies, that is the ROC, verify certain documents, and after that, ROC will issue something called as Certificate of Incorporation, COI, and that is when the company will legally come into existence. Okay, so now let's understand what documents are required for registration. Okay, now let us understand them one by one. Now, the first and the most important document is the MOA. What is MOA? MOA stands for Memorandum of Association. The Memorandum of Association is often described as the charter of the company. It defines the fundamental conditions upon which the company is formed. So, the MOA contains some important clauses such as name clause, okay, registered office clause, that is the state in which the registered office is located, then object clause and liability clause, and also the capital clause. Okay, now in simple terms, if I have to tell you, memorandum tells us what the company is allowed to do. It gives you a broader framework within which the company needs to operate. Okay, then for example, suppose a company is formed with the object of manufacturing electric vehicles. Okay, now its memorandum will clearly state that its objective is to manufacture and sell electric vehicles and related products. Now, if the company suddenly decides to start running hotels, now that activity may not be permitted unless it falls within the objects mentioned in the object clause of the MOA. Thus, memorandum defines the scope of company's activities. Okay. Next comes another important document, that is AOA, nothing but Articles of Association. While the memorandum tells us what the company can do, the article explains how the company will operate internally. Okay. Now the articles contains rules relating to appointment of directors, conduct of meetings, voting rights of members, issue and transfer of shares, declaration of dividends, and all of those. So, if the memorandum is the constitution of the company, the articles acts as the internal rule book for the company. Okay. Now, another important document required during the incorporation is a declaration by the professionals stating that all the requirements of the Companies Act have been complied with. So, this declaration shall be made by a chartered accountant, a company secretary, a cost accountant, or even an advocate. So, this requirement ensures that the incorporation process follows legal procedures properly. Okay. Then, the subscribers to the memorandum and the first directors must also submit an affidavit. Now, through this affidavit, they confirm that they have not been convicted of any fraud and are not guilty of mismanagement in any previous company. Now, this helps to maintain the transparency and credibility in the formation of the company. Okay. Next, the company should also provide the address of its registered office. Now, this address is important because it determines the jurisdiction of the registrar. Okay. And all official communication is sent to this office where it is registered as the registered office. Okay. And then later, the incorporation documents must also include details of its subscribers. Now, who are subscribers? Subscribers means they are the first members of the company who agree to take the shares. Okay. Now, similarly, details of the first directors must also be provided. Now, these were the important documents. Now, after verifying all these documents, the ROC will issue a certificate called as COI, that is Certificate of Incorporation. Now, this certificate is extremely important. From the date mentioned in the certificate, the company legally comes into existence. Let me ask you a very interesting question. Think of yourself as a judge for now, okay? Suppose someone later argues that there was a mistake in the documents submitted during the incorporation process. Now, can the court declare that the company never existed? That is, I'm talking about after the COI was issued. Can someone later argue that there was a mistake in the document submitted during the incorporation, and now can the court declare that the company never existed? Can you think about it? Now, the answer is no. Why? Because once the certificate of incorporation is issued, it becomes a conclusive evidence that the company has been duly registered. The legal existence of the company cannot be questioned afterwards. Okay, so please remember, certificate of incorporation acts as a conclusive evidence about the registration of the company. Okay. Now, however, there is one more important document, that is, even after incorporation, a company having share capital cannot actually start its business immediately. Then, when do they do it? So, before commencing the company must file a declaration stating that the subscribers have paid the value for the shares they had agreed to take. Okay, and this declaration must be filed within 180 days of incorporation. Now, this ensures that the companies are not created only on paper, but they have been created with real capital. Okay, and after this, the CCOB, that is certificate of commencement of business, will be issued. Okay, now that the company has been incorporated and we've understood the process of incorporation and also the documents that are required to be submitted, the next question is, how does the company raise money to run its business? Now, the companies raise funds mainly by issuing shares to the investors. Okay. Now, the money raised through shares is called as share capital. Share capital is therefore one of the most important sources of long term finance for the company. However, share capital passes through different stages. Okay, now let's understand and recognize these stages of share capital. Okay, so the stages of share capital includes authorized capital, issued capital, subscribed capital, called up capital, and paid up capital. Now let us understand each of this with simple examples. So, authorized capital is the maximum amount of share capital that a company is permitted to issue according to its memorandum of association. For example, if the authorized capital of a company is 10 lakhs divided into 1 lakh shares of rupees 10 each, the company cannot issue shares beyond this limit unless it alters its MOA. So I told you memorandum contains clauses something as capital clause. So in this capital clause, the authorized capital will be mentioned and the company cannot issue more shares than what is mentioned in the capital clause unless it is altered. Okay, and there is a procedure for alteration, right? Then we will understand about issued capital. So, issued capital is the portion of authorized capital that the company actually offers to the investors. For example, authorized capital is 10 lakh. Now, let's say the company does not want the entire 10 lakh to be raised at once. So, maybe as of now, they require just 6 lakhs. So, what do? They issue 6 lakh to the public for subscription. Now, this is called as issued capital. Okay. Now, let's understand what is subscribed capital. Now, subscribed capital is the portion of issued capital that the investors agree to purchase. Now, I told you company is wanting 6 lakh of rupees. So, it is issued 6 lakh worth of shares for the investors to subscribe. But the subscribers have only subscribed for 5 lakh of shares. Now, this 5 lakh of shares is what is called as subscribed capital. Okay. So, out of 6 lakh that was issued, public has only taken up 5 lakh. So, that 5 lakh is known as subscribed capital. Okay. Now, the companies usually collect share money in installments. Okay, they don't collect the entire money at once. They generally collect it in installments. Now, the amount demanded from the shareholders is called as the called up capital. For example, a rupees 10 share may be collected in three installments like rupees 3 on application, rupees 4 on allotment, and rupees 3 later. So this is how they can split and call the shares. Okay. Now finally, paid up capital. What is paid up capital? Paid up capital is the actual amount received from the shareholders. Okay. Sometimes shareholders may fail to pay the full amount that was called. Therefore, the paid up capital may be less than the called up capital. Okay. Now, let's move to a broader classification of share capital, that is equity share capital and preference share capital. Now, what is equity share capital? Equity shares are the ordinary shares of the company. So, equity shareholders are also considered as the owners of the company because they enjoy the voting rights, participation in the management, dividends depending on the profits. However, dividends on equity shares are not fixed. Okay. Now let's understand about preference share capital. Now preference shares carry preferential right over equity shares. Now these rights relate mainly to dividend and then repayment of capital during the winding up. So preference shareholders receive fixed dividend before the equity shareholders. Okay. Now let us understand this process of registration in the real world scenario. Okay. So imagine you are a professional advisor and a client walks into your office and says, I want to start a company in India. What should I do? Now, the first step is to understand the business idea and the structure. Now, you will then identify the promoters. The promoters are the persons who conceive the idea of forming the company and taking the necessary steps to bring the company into existence. So, the promoter's responsibility includes selecting the name of the company, preparing all the incorporation documents that I mentioned previously, then arrange for the initial capital, okay, and then if required entering into all the preliminary agreements also called as pre-incorporation agreements. Okay, so now let's understand this one after the other. So the first step the promoters must do is they must apply for the name approval through the portal of Ministry of Corporate Affairs. So if you go to their portal, you can find the portal is www.mca.gov.in. So if you go to this portal, you have to use the service called as run, that is reserve unique name. So you will submit your application over here, and then the proposed name, whatever you give, right, that proposed name should not be identical to any of the existing companies, and it should not even violate any trademarks, and also it should not be misleading or undesirable. And you already know, if you are wanting to start a private company, it should always, the name of the company should end with PVT Ltd. Okay. And if you are starting a public company, the name should end with Ltd. Right. So you should keep all these in mind when you're submitting your name application. Right. And then secondly, since incorporation is done online, the promoters must obtain DSC. What is DSC? Digital Signature Certificate. And also DIN, DIN. What is DIN? Director's Identification Number. Now these are required to digitally sign the incorporation documents. Okay. The next thing is incorporation documents have to be prepared. And I already told you what are those documents. Now, these documents include MOA, AOA, identity and address proof of the directors, then registered office details. Now, these documents are filed through the SPICE, SPICE plus incorporation form of on the MCA portal. Okay, so you just go through the MCA portal, you will find these documents. And then sometimes what happens, the promoters enter into agreements even before the company is formed. Okay, now these agreements are called as pre-incorporation agreements. For example, you may have to rent your office premises, purchase of machinery, hiring of consultants. Now, all these are some of the agreements where even before the company is formed, the promoters might enter into. Okay. Now, before I proceed further, let me ask you a question. If a company does not even exist because it's not even registered, and the promoter has already entered into these agreements, now who is responsible for these contracts? Now, the answer is the promoters themselves are responsible for these pre incorporation contracts. Okay. Now, after the incorporation of the company may adopt these contracts. Clear? Okay. Now, once the registrar verifies all the documents, the certificate of incorporation is issued. From that moment, the company becomes a separate legal entity capable of owning a property, entering into agreements. It can be sued and it can sue others as well. Okay, so in today's session, we understood how the companies are formed under the Companies Act 2013. So we clearly discussed the registration process of the companies, and then the importance of the certificate of incorporation, and then we also spoke about CCOB, that is Certificate of Commencement of Business. And then, of course, the different stages of share capital were discussed, and also the types of share capital was also discussed. Now, these concepts form the foundation of corporate law and corporate finance. So, in the next session, we will move further to understand about the different doctrines. Okay, until then, keep revising your topics. Thank you.